Hi, everyone. I'm so happy to be here, being part of the Real Estate WealthCon. Chris, thank you so much for inviting me. My name is Bill Fairman. I am the co founder, along with my sister and business partner, Wendy Sweet of Carolina Capital Management and Carolina Hard Money. I'm also the manager of the Carolina Capital Reserve Fund. So, what we're going to cover today is how we are uniquely qualified to talk about this space, the current market that we're in, and the opportunities within those in that market. The most defensive space in real estate to be in at this time and why, along with due diligence. How do we protect ourselves? We can't be perfect, but we can cover as many bases as possible because there's nothing we can do about market conditions we have no control over. But there's lots of things that you have control over. So, why are we qualified? Well, 20 plus years in the mortgage industry, 30 plus years as a real estate broker in 2 states, and 7 years in the mortgage industry. And that was all just before the financial crash. Now, that is combining myself and my sister Wendy. Wendy had been in the real estate space for a long time, 30 years as a real estate broker in 2 states. I actually helped her get into the mortgage industry initially. But, after the crash, like thousands of others, I found myself, and Wendy did as well, unemployed. And it was no fault of our own. The system crashed. The mortgage business went down to about 25% of its size before this crash. So there was a lot of people struggling out of work. And it wasn't just the mortgage industry, tons of industries where people found themselves out of work. Now, after struggling for a while, I did try to do some things. It's a shame when you have over 20 years experience in an industry and that industry basically goes away. It didn't really go away, but I found myself in a position where I was overqualified for every single job in that industry that was available. And it was very difficult to find work. So I ended up finally asking my parents. Now, I'm 50 years old at the time. So it was difficult to ask your parents for a loan. But I had to borrow money from my parents to get my commercial truck driver's license. I began a career then as a long haul truck driver. You see, like I said, I was overqualified for every mortgage job that was available. But in the trucking industry, there was a shortage of truck drivers. And, they could really care less about your qualifications as long as you met the licensing requirements. They were just concerned about having butts in the seats. So here's my rig towards the end of my truck driving days. When I first got into the business, I was making around $28,000 a year working for a major carrier. But I used my communication skills to get into a much nicer position. By the end, I was making around 85,000 a year. I had quickly transitioned to this smaller specialty company that gave you a lot more quality of life, but still driving a truck. It's a tough business. It's a noble profession, but it's a tough business to be in. You're always gone on the weekends and holidays. You miss your family. This particular position was what they call a dedicated route. I knew exactly where I was going. I went same place every week. The truck right now is sitting in Hagerstown, Maryland. My day would start off on a Thursday morning. I'd pick up a load in Charlotte. I would drive it to Troy, New York, which is up near Albany, western part of the state of New York. I would drop the load off there. I would work my way back to Hagerstown, Maryland, and I would sit for 2.5 days in this truck stop waiting to pick up freight from Air France. The specialty company that I worked for, they were an importer of Bavarian products. And what I meant by that is they worked with a lot of companies that did machining, furniture making, all kinds of stuff. But the equipment came in from Germany and Denmark and those areas, and it would be flown in via Air France, and then we would distribute those parts out to the companies in the Charlotte market at that time. But my job was to go pick it up and bring it back. So as you can see here, I had plenty of time to think while I was sitting around for 2.5 days waiting for my next load. Now, when I wasn't watching DirecTV, I don't know if you can see that dish on the top, so at least I get to watch some of the games while I was out there. I had plenty of time to think how I got myself into this position in the first place. I had probably one of the best jobs ever before the crash. I had a really good 401k. You never want to touch that 401k when you're in trouble, because that's your retirement money. But my 401k not only ended up losing half of its value, I ended up having to cash it out anyway just to make, pay our bills. But how did I get into this in the first place? Well, I was not a real estate investor. I was a worker bee in the mortgage industry. And this time I got to sit around and think about what could I have done differently so I wouldn't be in this position stressing about bills. If I'd have been a real estate investor, I would have had enough passive income that I still could have done some part-time stuff or maybe even a little bit more investing to continue doing passive returns. And this is where I got my passion for trying to help people. I don't want anybody else to go through the same thing that I went through. It was um, very agonizing at age 50. You're so pretty close to retirement by that time, and now I'm having to start all over again. Well, again, I don't want this to happen to anyone else. So that's where I got my passion for helping people understand passive income. Now, Wendy took a different path. When she had to shut down her mortgage company, she ended up going into seminary school. And while she was doing that, she was doing some hard money loans on the side, but her business began to grow and she needed some help. Asked if I would join her in business, and it was the perfect time as the banking industry was very tight. There was a need in the marketplace for private lending to help real estate investors do fix and flips. You know, After the crash, the banks were really tight, and no one could get any money to do this because it was, in their mind, high risk loans to take a house that's distressed, um, fix it up, and then sell it. If you had you if you could get a loan, they're not going to give you the loan uh, to fix it up. They would give you the loan as is. But most banks wouldn't even do that because they don't want to have to take it back if it's in distressed situation, and then they would have to turn around and sell it. They had plenty of inventory on their hands already. So there was a great need in the marketplace to do this. But her and I started out with just us two and a part-time bookkeeper. The way we look is a little bit different than when we started, obviously. But to back up just a little bit, how we started in the business is that we knew people that needed loans, and then we knew people that had self directed retirement accounts that were trying to put their money to work. And we would just put the two together, and essentially we would broker the deal. The IRA holder would get all the interest rates, and we would get the points and do all the work for them. So here we are today. The business um, grew so quickly that doing the broker part was really became unwieldy. The individuals um, became, well, let's put it this way: we were working with around $28 million of other people's money, and having to put the pieces of the pie together became a little bit more difficult than actually putting the loans together. So in 2014, we started the Carolina Capital Reserve Fund, where everyone could take that money and pool it together and make things a whole lot easier on one side. Plus, it makes it much safer for the investor themselves to have all your money pooled. You have a lot more diversification across the entire portfolio versus lending money on one asset. So this is our office now. we have 12 people in the office, and then we have a number of contractors and remote staff as well. As you can tell from our story, we've been around the block for a while. We understand all the different markets, all the different market cycles. So we have some tread on this tire. We've seen these cycles before. So, what's the current market that we're in right now? Interest rates have gone up nearly 5% in 12 months. I mean, that's quite the shock to the system, don't you think? And it's not just residential, but commercial as well. Uh, See, in the commercial world, value is based on the income that the property produces. So if you're forced to refinance and your income is down, which Murphy's Law says when you're forced to refinance, you're going to have a market downturn. That's just the way it works. Uh, then the value of your building is lower because you probably have more vacancies in that building than you normally would. And in some cases, you'll be upside down in value, just like in 2008. So if your property is a little bit over leveraged, you have some vacancies in there, you're not making as much money, you get the valuation of that property, you go to refinance it, and you end up owing more than the building's worth. So again, it harkens back to 2008. Office space is going to be the most hardest hit since the pandemic. Fewer people are working from an office. So there's more vacancies in office space. So that's the market to kind of fear, in my opinion. Now it depends. You know, uh, real estate is hyper local, so there's going to be areas of the country where people are moving from. Some of the areas where people are moving to, the office space is in a lot better positions. But keep an eye on that nationally because that's going to be a trend. So far, we've had 3 bank failures this year, right? And guess who does um, somewhere in the 80% range of all commercial loans? It's these mid-sized banks that have been failing. So do you think they're going to be a little bit more conservative about their new loans going forward? And like we were talking about here earlier, 270 billion in commercial real estate loans are set to mature in 2023. Now, what that means, I don't know that I covered this earlier, but if you have a commercial mortgage, they are not 30-year, 20-year loans. They are 3, 5, 7-year loans. They may be amortized over a 20 or 25-year period, but you have to refinance those things every so often. And if you got 270 billion or set to refinance, there's going to be some issues coming down the road. Inflation. Now, inflation is coming down, and the last read was 3%, but that's on top of the 12% we had last year. So it's still compounding. Inflation isn't down; it's just not growing at the rate it was earlier. So all this uncertainty leads to fear, and that makes people hold on to their money, whether it's institutional investors or whether it's individual. We also have out of control government spending, international conflict and turmoil, and like I said, that fear is what keeps people from investing at all. And if you're not investing at all, obviously you're not keeping up with inflation. So what does that mean? You're going to end up losing money over time. So here's the challenge: how do we invest defensively while keeping up with inflation? Well, the spaces that we like are residential housing, and we're talking about multifamily as well as single family. Nationally, on the single family side, we are 6 million homes below the number of household formations. This has been an ongoing problem since the 2008 crash. When the crash happened, there was so many people that got out of the building industry, number one. So there's always been a short supply of good contractors, but we've just never been able to keep up. A lot of the single family builders have now moved into the multifamily space as well. But only 1% of the single family homes last month changed hands. Typically, it's 4 to 5%. So, why is there a shortage? Number one, in my opinion, there's fewer people that want to sell their home to move up to the next home because interest rates that they have on their home are, between 2 and 4%. Why would you sell your house to go to a 7% loan? It's just too expensive to move up to that next home. Not to mention the cost of living is going up. Um, in general, the builders aren't keeping up with household formations because entry level homes do not have enough margin in them to make a profit to make it worth their while. A lot of builders, like I said, are turning to multifamily or build to rent construction. So all of that is adding to the problem that we have with not having enough inventory to keep up with household formation. By the way, last month was decades record. 12.5% of all home sales were new. What does that mean? Uh, Typically, home sales for new construction run between 8 and 10%. But because there's no inventory for existing homes, people are having to turn to the new homes. So it's up to 12.5%. Um, like I said earlier, keep in mind real estate is hyper local. So the numbers may be different in different areas, but for the most part, the shortage of single family homes are going to keep values pretty much where they are. I know we're in the Charlotte market, the Southeast. There's still bidding going on houses. There's multiple offers still going on houses. The rate of inflation or um, the values of homes going up has slowed a bit. You're not going to get the 20% appreciation like you had, but they're not dropping in this area. They're going to continue to go up for a little bit. So these homes are going to continue to appreciate over time. Another space that we like very much is commercial strip centers. We love strip centers. They don't suffer from the Amazon effect. What I mean by that is, um, you know, Amazon can't deliver your hot coffee. They can't cut your hair. They can't do your nails. You can't go in and work out at Amazon. They can send you some stuff to work out in your home, but as you and I know, most of the time when you buy home equipment, it becomes a new place to hang your clothes. um, we love the strip centers that don't have the large anchor tenant. If you think about it, you don't want a third of your income on the rental side coming from one tenant. You would rather have it split among several, right? So this is why we like those. Now, you can get them, and they would be perfectly good, viable businesses, making a good passive income with something that looks like this. But as the owner of a property, excuse me, um, you really have to do facelifts on these probably every 10 to 15 years because part of your job is to bring consumers in off the street because these are going to be on main roads. You want them to look good in order to bring customers in and also to make sure that you can continue to go up on rent when the leases are up. So here's a couple of things that you can do to improve these things, and they don't cost a whole lot. As you can see, it's just a little bit of cosmetic stuff, adding an awning, staining the concrete, sanding it, painting the front. You can add, um, well, you're always going to be wanting to uh, take the parking lots and spray them. They call them resealing, and then painting the lines in the parking lot. Do us all a favor though, and don't try and get more cars in there than you need to. Um, don't squeeze the cars together so everybody ends up with dents on their doors. Okay. Here's another space that we love: self storage. Not only do we love it because it makes uh, great real estate is part of that, but it's also a business. We love it because it's recession resistant. Because we as a nation have an unhealthy relationship with our junk. Uh, when you're working your way up the economic ladder, you buy new stuff, but you don't want to get rid of your old stuff. So what do? You store it. On your way down the economic ladder, you downsize your home, but you still have stuff you don't want to get rid of. So you put it in storage as well. If you have a relative that passes away and they leave you stuff, now you're emotionally attached to it and you won't get rid of it either. So, um, one of the things we love the most about self storage is that it is SBA friendly. What I mean by that is the Small Business Administration will loan a lot of money on a self storage. They consider it not only real estate, but they consider it a business. With businesses, you can get up to 90% financing with Small Business Administration. You can actually get money as part of your refinance or purchase for working capital as well. You can't do that with a commercial property. Most commercial property loans with a bank, you're getting 65% of the value if you're lucky. And like I said, it's very recession resistant. You can use it in all types of economic climates. Here's another thing you can do with those. Remember those big anchor stores that I hated in the strip centers? Well, you can easily convert those into self storage. As you can see, now it's all climate controlled. You just throw a few of these lockers in there and you're good to go. Now, the most defensive space in real estate. Where is it? We call it being the bank. Now, I showed you the property types that are really the ones that are going to be recession resistant and ride through this. They're also, by the way, the most liquid of all the real estate property types. Meaning, if you have to get rid of them, you're able to get rid of them quickly. You're able to sell them a lot faster. The commercial multi-tenanted is always going to have income coming in, and then everybody needs a place to live. In any economy, you need two things: food and shelter. So the multifamily or a single family, you're still providing shelter. You're providing one of those. But do you always want to own it? Not necessarily. There's advantages to being the bank. Being the bank, think about this. Most all the beautiful office towers in most cities are owned by the banks. Why is that? Well, they have all the money. They make all the money. Albert Einstein once said, "Those who understand interest will receive it. Those who don't will pay it." So you want to be on the lending side. Number one reason you want to be on the lending side, as the lender, you control the asset without being responsible for owning the asset. As the lender, you're not responsible for the taxes, the insurance, the upkeep, and maintenance, homeowners association dues, and the rules that come with it. Investment properties, if you're lending on those, you don't have to deal with tenants, toilets, and trash, but you're still getting uh, passive returns, just like you would if you were the person that owned the property and getting cash flow. You're still getting cash flow. You're just getting it from interest versus leases. So you are getting, cash flow from those interest payments. You're in a much better equity position as the bank versus the owner, because as the from the lender side, on the banking side, you're going to only be in the properties for 60 to 70% of the value of that property. So, worst case scenario, if you have to take it back, now you have this equity built in. And keep in mind, this equity is not there for you to make profit. This equity is there for you not to lose money. So that's what you want. You want plenty of cushion when you're taking a property back, because there's going to be expenses when you sell them, when you hold on to them, when you take them back. But 60 to 70% of the value is a good equity position to be in. Last but not least, being the bank is better for liability. As the lien holder, you're not going to get sued for something that happens on the property. If there's a slip and fall or a fire or anything like that, they don't sue the bank. They sue the owner of the property, not the bank. So the question is now, how do you invest as the bank, right? Well, first way to do that is to create notes so you can be what we call an originator of a bank note. You become the lender, you set the terms. Um, a couple of tips I'm going to give you. Use If you're going to do this, you need to use an attorney, and it needs to be your attorney. Borrowers can always get their own attorney, but they're going to have to pay extra for that themselves. They're already going to be paying for your attorney. I want to keep this right up front. You have the gold, and that's the old golden rule. He who has the gold makes the rules. So if you're lending money, all costs involved in a real estate transaction, when you're lending money, the borrower is going to pay. You need to do that. You need to make sure that the borrower is paying it, not you. So these things that you have to get up front is insurance for yourself. So always use a real estate attorney. Um, you need to get title work done, and that's getting title searches, making sure there's no chain or a break in the chain of title. You want to get title insurance in your name for at least the amount of the loan to cover you in case there's any issues. And then the borrower should, they don't always have to, but they should get title insurance for the value of the property. So you're getting title insurance for the value of the loan, they're going to get it for the value of the property. If there's a construction component, you never want to give the construction money in advance to the borrower. Believe me, we've been doing this a long time. uh, you hold on to the construction money and you give it in draws after work has been completed, not because somebody told you it was done. Here's another tip. You're getting an appraisal before you do anything. We get subject to completion appraisals along with as is values. The same appraiser that did your appraisal can go out and do the inspections every time the borrower wants to do a draw, construction draw. And they're going to go out and they're going to do a nice report saying that this work was completed up to standards. And they're going to send pictures and make sure that it was done. Because I can tell you right now, somebody can bring in a set of cabinets, put two screws in it up against the wall, take a picture that they're in. Um, Soon as they get the money, they take those cabinets down and they put them in another house, take another set of pictures. Ask me how I know. This is this is why you get a third party to go out and do these inspections for you. Keep in mind, like I said, any fees or costs, the borrower is going to pay these. You do not have to pay those. This is part of them doing the loans. You can also, if you don't want to get into the new note space, you can get into purchasing existing notes. Another great way. Now, this is a loan that's already ongoing. Um, all the due diligence has already been performed. You just need to make sure that it's true. You have all the appraisals done, all the income documents, make sure that they can afford the loan. All this has already been done. You're just verifying it. You're just deciding at that point, is the loan worth the risk? While you have all that documentation to look over, is it worth the risk to you? If it isn't, you can always negotiate a higher rate of return from the person that's selling you the note. In other words, if somebody says, I'm going to sell you this note, you're going to get a 10% return. You're looking at the note and the collateral and you're thinking, well, this wasn't documented like I like it, but I still like the property and the place and the person, but it's a little bit too risky for me. I want 11% return. And you do that by paying less for the loan. Okay. So there's all kinds of ways to work these things out. You can buy for example, a stream of income from a note. Let's say, for example, you have a 15-year loan, and you want to buy. You can buy 5 years, or the first 5 years of the income, and the second 10 years that's left would revert back to the original owner. Now, if you're the owner of the 15-year note, you could do the same thing. You could sell somebody 5 years of payments. Why would you do this? Well, it's possible that you could buy a 15-year note, sell the first 5 years to somebody else, and nearly pay for the entire note with the 5 years that they give you up front. And then the last 10 years is just gravy. You're basically, somebody else paid for that or most of the note, and now you're just getting the rewards. Now, the person that bought the note is still getting cash flow. They're making money too. So it's a benefit to everybody. But if you're the one that found the note and did the work, you should get most of the rewards. um, this is not as actually either side of these notes are, they're not as passive. They're a little bit more active than uh, some. It's not nearly as active as owning property, but it's not as passive as others. There is a little bit of work that you have to do to these things if you have the time, but there's plenty of companies that will do a lot of this for you. Debt fund investing, though, is a great way to be truly passive. That doesn't mean you're completely passive. You still have to do your due diligence on the manager and the fund. The fund has to invest in stuff that is within your investing goals. Okay, so you have to still have to do your due diligence on what the assets are in the fund. Is the fund manager doing what they're supposed to, or is their philosophy in line with your investing philosophy? But this is how the ultra wealthy make their money. They don't have time to do stuff that's semi passive. They want to do stuff that's completely passive because they got other stuff to do. They just invest their money in different private placement funds, and that way they can be more diversified as well. You have to be, in most cases, not all funds, but in most funds, you have to be an accredited investor. And what an accredited investor means is that you have to have a minimum of $1 million in net worth, not counting your primary residence, or you have to make 200,000 a year and have been for the last two, and assuming you're going to continue to do that as well as a single person, or as a family, it needs to be 300,000. And there's also other designations. For example, if you're a licensed CPA, um, you don't have to, or you're considered accredited. If you're a broker dealer on the stock side, you're also considered accredited. And there's a couple of other things. They've widened it out a little bit to allow more people to be accredited. Um, if you're someone who has plenty of rental property, you may be accredited and don't know it yet, but it would be helpful to have your CPA check it out for you. It's funny, they set these rules up for accredited investors. The last time they changed it was in the 80s, but they haven't upped the amount yet. So people that have a net worth of $1 million back in the 80s, uh, if you figure in inflation and cost of living, they probably were in the 250 to 300,000 net worth range compared to today. So it's really an advantage at this time, um, them not changing or upping the amounts. So let me talk about some of the advantage to being in a fund versus owning individual loans. They're both good. They both have their good points. They both have their downsides. The first thing, inside of a fund, you're diversified over an entire portfolio of loans or assets, depending on the type of fund it is. You're choosing a fund that owns real estate, then it's the assets. If you're choosing a fund that lends, it's the liens that are against them. When you own an individual property, you have an individual or have an individual loan, you have a larger chunk of change that is invested into a single asset. Now, if things go south, it doesn't mean you're going to lose money, but you're certainly not going to be making any money while you're figuring out the disposition of the property or the loan itself. Um, but that's why you have a lien on these properties, or you own this property. It's a physical asset that has value. Okay, but when you're dealing with one, there's a higher chance that things could go wrong, and you could lose money, or you're really going to work hard. One of the two. If you're working with a fund that allows you to compound your distributions, then your money is always going to be working. So let me give you an example. If you have an individual loan, say from your IRA, and you're getting monthly payments from a borrower, what are those monthly payments doing? Do you have enough money to reinvest those payments, say, into another loan, or are you just having to wait till you get enough money to invest in another loan? It's very difficult to invest $3,000 into something. It's a lot harder to invest 3,000 than it is to invest, 30,000, right? So if that money's sitting there doing nothing, waiting for the money to be repaid so you can reinvest it again, then we consider that lazy money. If and if you're waiting for that other loan, like I said, we call that lazy money. But here's an example of that. Let's say you have an 11% interest rate and you have it invested for 11 months out of the year. So it's paid off after 11 months. Your interest or your yield is annualized. So you've got a gap of 1 month that money's not invested. Now your return is around 9%, not 11. So when you're in a fund, that money is always working. It never stops. If you're in a fund that is equity based, and let's say you're the owner of that fund, and it could be a property fund or it could be a lending fund. In a property fund, you own the properties, you have equity position in the property. So when the property sells, excuse me, not only are you getting uh, income from that property, but when you sell it, you get a capital gain. Um, when you're an equity partner in a company that lends money, you're getting paid profit at the end of each quarter or month, however they do it. It's not a guaranteed return like a loan, although the activity that the fund is doing is lending. You are an owner of a business that makes a profit, and so you're getting paid profit at the end of, like I said, every quarter or month, depending on how the accounting is done. Um, if you have a fund that allows you to lend it money, there's another option there. It would be like buying a CD where you're going to agree to lend that fund money for, say, 3 years or 5 years or um, somewhere in between, a year maybe. Typically, the shorter time that you're lending the money, the lower the return is going to be. The longer you give them your money, obviously, they're going to pay you a little bit more for that. When that period of time matures, they're going to give you an option. Would you like to lend it to us again for a certain period of time? And then they can roll it over into a new note. When the time runs out, you have the option again to lend the fund money again or to put it into some other type of investment. The difference here is there's going to be more upside to being in an equity position than on the lending side. But on the borrowing side or the lending side, if you're loaning the fund money, you're going to get a guaranteed return on that lending side because it's a fixed rate of return. The key to all of this is knowing what you're doing and doing your due diligence to start with. So if you're thinking about doing notes, I would tell you that if you're an accredited investor, well, let me back this up. If you're an accredited investor and you have the mentality to be passive, and I say this jokingly because if you're in a fund, you need to be a passive investor. If you have the personality type that you need to micromanage everything, do not get into a fund because you're going to drive yourself crazy and you're going to drive your fund manager crazy. If you like playing the game and you're not accredited, I would look into the note business. And I have two great resources. Uh, One of them who is actually going to be this weekend speaking. Check them out, Eddie Speed with Note School, and some other good friends of ours, Fred Rury and Tracy Z. They all the name of their company is Note Investor One or Investing 101. They all have great courses on teaching you how to do the note business, and there's a lot of moving parts in this. I would learn as much as you can. The other way of doing it is investing alongside of someone, buying notes from people that are already doing it. I highly recommend both Eddie and Fred and Tracy. I've done courses with them, and I've been in the business for years and years. And I'm telling you, when you get into these things, listen, I'm old and I can be learn new tricks as well. It's amazing what you learn from people that have been doing this for quite some time. Now, on the due diligence side, I have a free gift for you. So I have on the due diligence for funds and fund managers, I want you to go to billfairman.com. I have a uh, tab in there called free gift. So I have a PDF with 10 questions that you should ask a debt fund manager before you invest. Not only do we give you the questions to ask, but why these questions are important to ask. I also have a free ebook that I put together called Equity Investing in Mortgage Pool Funds. BillFairman.com. You can get all my contact information, all my social media, all my videos that we have in there that teach you about this stuff, my events calendar, as well as being able to schedule a chat with me. I'm happy to help anyone that has any questions whatsoever. But these free gifts are going to help you on that due diligence journey. And again, I recommend Eddie and Fred and Tracy for the note side of things as well. It's been my pleasure. Again, BillFairman.com. Anything that we can do for you, we're happy to do so. Thank you very much for having me. Hope this was helpful.